So like I introduced myself earlier this morning, I'm Rick Dehod. I'm the Farm Financial Specialist, Alberta Agriculture and Forestry. I've been working in the ag industry for a long time, nearly 40 years. The first 32 with a major ag lender in Alberta, helping them work with their clients to meet their financial goals or help them deal with financial problems so they can meet their financial goals. I've been with Alberta Agriculture now just about 6 years, and one of my jobs is to bring this to you. I too was in the beef industry when I was 17 years old. I had 3 cows. Grad night, I crashed up my dad's car. Next day, I signed him over to him, and I was out of the beef industry. So, transfer of wealth. Anyway, one of the things that I'm going to talk to you about is a Farmer's Guide to Agricultural Credit. We have this as a PDF or as a resource in our farm manager site, but I'd just like to talk to you about it and why the importance of agricultural credit to your businesses. First of all, we know that agriculture is a very capital-intensive industry, and like Herman pointed out earlier, that cash and equity is often a limited resource, especially when we're starting. So to meet our financial goals, to meet our production goals, we often leverage our equity with debt. And debt seems to be an important part and stress for most agricultural operations as we started and we moved through it. And I know that in my own relationship, the most heated discussion has been about financing and debt. And it can be really stressful, but it is a tool that all operations, especially in agriculture, have to learn to use. So we know that from the 2011 census to 2016, we've seen the average balance sheet of a farm in Alberta go from nearly $2.5 million to nearly $4 million. That's a lot of money. And we've seen debts go from $321 to $500,000 for average net worth of $3.5 million. So, because you guys have no cash, you don't really think about that. But as a Canadian, you're in the top 10% of wealth earners. Just don't have any cash. Now, that average $500,000, you got to remember the average farmer in Alberta is 55 years of age. There's a lot of people older that have no debt, but there's a lot of people younger that have a lot of debt as they try to lever that limited resource called equity and cash so that he can do what they want to do. We've seen that total farm debt in Alberta has doubled in the last 10 years, from $11 billion to over $21 billion. And part of that has been the appreciation of farmland. If farmland was worth $1,000 in 1980, we've seen that it's gone up to 3,500 acres. And in the last year, according to Farm Credit, it appreciated in Alberta about 9.5%. And in the last 20 years, land was a good investment, better than the stock market. It averaged over 7%. And in the last 10 years, it's averaged close to 9%. So that $3.5 million net worth, a lot of it is under appreciation that's occurred through land values. But also, those increased land values and increased amount of debt that farmers have had to carry as they have tried to expand their businesses. So some of you are bankers and some of you have been in the business a long time, but we're going to review some of these things. So we know that operating loans is a cash to maximize the daily activities of your operation, includes working capital. And repayment is usually less than 18 months. They're usually through revolving lines of credit or revolving loans. They're secured by inventory. We know that when you start out, depending on the inventory, your creditors will advance you 50% of the value of the inventory, depending on the year. You know, on feeder calves, usually they might go up as high as 70%, because as the weight goes on, those calves are worth more, and it'll come into that 50% basis. Or some of the producers, because they don't like the farmers calling around their place and counting inventory, just take a quarter of the land and they manage it themselves. Short-term variable loans, those are usually under 10 years. Usually what you do is you take the loans for the life of the assets. You don't want to be paying for something after it's depreciated and you've traded it or it's died. So what we see on long-term loans On equipment, up to 10 years for new, 7, 5 years, depending on the age and the type of equipment. On cows, we see 3 to 5, depending on the age of the cows, because we know with culling that in 5 years, you're going to, if you financed 100 cows, you're going to have 60 cows left. So the principal has to be repaid, so that security margin. Plus, you don't want to keep paying for those animals when they're all gone, or that equipment when it's all depreciated out. Because usually you want to lever it and trade it up and go through the whole process again. Long-term loans, we have variable fixed rates and terms, amortizations up to 30 years. It's for buildings, lands, improvements. We see it for renovations, clearing and breaking, and irrigation and drainage. So basically anything to improve that property. So what we're going to talk about is all of you are going to sign loan documents. And there's quite a few transactions, contracts for you to sign. There's a loan agreement, a promissory note, depending on the type of security. You often see a promissory note for a short-term loan or trade credit. You might see a security agreement that's registered at land titles or personal property, and a financing statement. But all these documents, it's your responsibility that you read them, because understand those rights and responsibilities. The creditor, the banker, they're all governed by different statutes. In Canada, we know that the interest rates are legislated by the Interest Act. Banks operate under legislation under the Banks Act. Property is registered provincially at land titles under the Law of Property Act and under the Personal Property Act for personal property. So there's all kinds of statutes to protect your rights, but with rights come responsibilities. So quite often we read the first page of any credit agreement or security agreement says, you get so much money at this interest rate, but we don't read further in if things go wrong. What's default? What are my responsibilities? It doesn't say good person can pay when they want. It says good person will pay when they promise to. So understand what you signed and what your responsibilities are. When you get funds, usually on long-term loans on under 10-year loan, you'll sign for that money to say that you got it, because you have part of the Bank Act or any act that you received that this person received those funds. Often under a revolving loan line of credit or an operating loan, you'll get a limit. You'll negotiate on a limit with your financial institution and draw those funds up and down as your cash flow allows, and you require those funds to run your operation on a day-to-day basis. Other terms and conditions, the payment types. We know there's blended, level payments. We know there's fixed principal payments, interest-only payments. We've seen that. One I know of is Farm Credit's Ag Advance or loan, where you manage how much principal you pay. You pay the interest. You draw principal out as required, and it's usually financed against land. Or there's interest only with balloon payments. Example of that in the wine industry, they'll seed vines, and it takes 4 years for those vines to produce. During those 4 years, they pay interest only, and when they start to produce, they making a principal payment. So here's a blended payment. The payment stays the same, so you can cash flow it. You can calculate how that fits into your cash flow. We see the principal slowly increases and the interest. So that's a great planning tool. We know we've seen fixed payments, and we've seen that quite often on equipment loans, where it's a fixed principal payment, and every year the principal comes down, but the interest charges are a little larger in the initial year. So for cash flow wise, in that other blended payment, it was $11,000 a year payment. Here is $12,500. Interest rate, we always like the lowest price, and we're always looking for the cheapest interest rate. But things that affect interest rate is type of interest term that you take. An open rate allows you to make a prepayment or convert at any time. But with that, it might be the cheapest cost, or it might carry a little more cost because you have the option to convert. You may want to take a look at a closed rate, because that as you commit for that longer period of time, the rate will offer you some security, but it might also be a little cheaper depending on your operations and what you're financing for. So not only are you looking at the cost, but what benefit it provides to your operation. But we have to be cognizant, because sometimes we get the lowest interest rate, but we have to put in all these other fees, because those fees could be driving, if you add them into the life of your term of the loan, they could add maybe another 50 to 100 basis points to your cost of funds. That's the loan application fee. For some long-term loans, you'll see the first $200,000 at $5 a thousand, and then go down. If you go through a mortgage broker, you might see, depending on the size of credit, a $20,000 fee to sign up the loan. Real estate appraisals, depending if the credit institution you're dealing with has in-house appraisers, they might include it, not charge you that. But if the loan is sizable enough and risky enough, they may request that a fee appraiser do an appraisal on your property. And depending on the value of the property, it could be from $2,000 to $10,000. Credit searches, you're going to pay for those. They're going to search personal property registry to see if there's any liens against your name. They're going to pull an Equifax or TransUnion statement to see what you owe. They're going to do land title searches. They're going to do Bank of Canada searches. And the legal cost of placing the credit. Also, we know that depending, while you're registering, there might be mortgage title insurance, and you might have to pay that depending on how much equity you put in. Plus, if you're purchasing property, it's going to be property tax adjustment. So all these costs add up into your financing costs, and they're the cost of doing business. Payment frequency. We often see that long-term loans could be usually set up on your cash flow, monthly, quarterly, semi-annual, and how it fits your cash flow. Timing of payments must coincide with high cash flow periods. A lot of our creditors now are doing loans on a scorecard system. Part of the scorecard system is your history of payment. So take a look. I had a young lady that, when I was lending money in Leduc from another institution, set up a beef producer on an August 1st payment. It became a war. 90 days later, she was calling him saying, "You're in arrears, we're going to have to charge you more interest." Her credit part was calling her to go out and collect the money and hassle the fellow. But the problem was the farmer and the young banker didn't set the payments up on the appropriate time. So all of a sudden, because they were doing credit reporting on her, they drove up the interest rate. If they would have looked at their cash flow and saw that it was a cow-calf operation, they sold calves in November and put that payment December 1st, that farm would have got a better interest rate because he had always met his payment. And he wouldn't have been always hassled by the young banker to provide credit reports, when all it was is they forgot to put the payment that met their cash flow. So be really cognizant when you set up your payments that it meets your cash flow and fits your cash flow and fits the seasonality of your operation. Because it can cost you money in interest rate, it can cost you money where that creditor might not want to deal with you, and it can be easy just by doing a little cash flow before you even start. Amortization. We've talked about interest term. We know that interest term open is usually 1 year. You can lock it in for a number of years. But the amortization is the length of the loan that meets the life of the asset. So like I said about cows, maybe you want to go 3 to 5 years, equipment, depending if it's new or used, land, 15 to 20. But you have to be careful, because a lot of us want to get out of debt really quick. And sometimes what I've seen is shorter amortization, people are worried about the amount of interest they're paying, and they take a short amortization. But what that does, it increases the payments. And you got to remember that principal portion of that payment is in after-tax profits. And that comes out of the money that you use to reinvest in your operation for it to grow and working capital. By getting too aggressive on a shorter amortization, you might limit the working capital to pay your day-to-day bills. You may want to take a longer amortization to lower your payments as an insurance so that you know you can meet those payments. But take a look at the interest term. So if you have a shorter interest term with a maturity date, you might be able to put a balloon payment to still meet the goals of what you have. But if you have a rough year, like some of the people with a dry year, you know at least you can make your payments. So it's a balance. It's a tool. Credit is a tool. And it's a resource that we all have to use if we're in the farming business, because it is so capital intensive. Collateral requirements. Know what the collateral requirements are. Mortgages secure land loans and they're registered land titles. And land titles guarantees that there's proper registration. On the back of the title, it shows all the liens and claims to that property in an order. Intermediate loans are personal property. They're registered Personal Property Registry Act. And that's usually for livestock, breeding stock, combines, equipment. And operating loans can be secured by inventory, registered at Personal Property Registry, or like I said before, you can register land. But you also have to realize under the Bank Act, it's a federal statute, and the banks can register a general security agreement under the Bank Act called Section 427 that has a claim on all of your personal property. And because it's a federal statute, there is a hierarchy of statutes, federal, provincial, municipal. The federal statute supersedes and trumps provincial statute. So often what you'll hear if you're dealing with, say, a credit union or with a non-registered chartered bank is they'll ask you to get a postponement if you have 427 with the bank. And they might ask for a subordination agreement, so they have charge over that item. Now we can talk about other issues on registering for intermediate loans when you purchase. There's PMSEs, purchase money security agreements. There's another document that we have that talks about placing security and knowing how to provide security in Alberta. Because law property and personal property is provincial statutes. Again, also we have to take a look at guarantees as we incorporate and move to incorporation, or often we'll see when there's a young person entering into the industry that mom and dad might be asked to provide a guarantee. There's maybe personal guarantees that you can take a full guarantee for the loan or limit it to a certain level. But that's all negotiated. And you have to understand and appreciate that. Also, corporate guarantees, full or limited. Prepayment penalties. Understand prepayment penalties. Like with these interest terms, if you take a fixed term, it may carry a prepayment penalty. And it's the fees charged to the lender when it's paid prior to maturity. You have to understand that banks and credit institutions have no magical pot of money that they borrow those funds from another organization or our savings account. They tack on administration fee, they tack on a profit, they tack on risk. So when you prepay your loan prior to when you're a fixed contract, you may be required to pay a prepayment penalty because while they're looking, you have to pay while they look to replace your money someplace else because they have a contract to honor to somebody else. And in Canada, that's interest differential or 3 months interest penalty, whichever the greater is. So you have to understand that if you win the windfall and you want to pay your loan off earlier if you're in a fixed contract. Refinancing. Often what we're seeing, you may consider refinancing if interest is falling better, interest rates are falling, you want better service of your debt or you want to lengthen the amortization. Often we'll say that you're maybe you've purchased some land. You're 3 years into it, another quarter comes up. And you have the repayment, but you'd like to refinance the first loan, amalgamate it into the second, lengthen the term so your payments are the same so that you can handle both purchases. But that refinancing has a cost. Know if you can refinance, what the terms are, what the cost, the prepayment penalty or interest differential will be due for doing that refinance. And you have to look at the risks and benefits because sometimes it might not be worth refinancing because the cost to refinance and pay that interest differential might be higher than that it's valued. It might be just better to run out the end of the term and then make arrangements to refinance the whole thing at that time. Conversion. Often we've seen right now variable rates and open rates have been a good deal for the last 15 years. Rates haven't gone down. People have been going on open and or prime plus one on prime rates. They've been low. So people have traditionally lately, largest portion of rate has been on open and open variable. But as we see interest rates move up, if you want to buy some protection for your farm, you might want to lock interest rates in. Because right now we came off the last 10 years, interest rates have been under, prime rate has been under 3%. But as we move higher, you may want to lock in at a 5-year rate, because if you think interest rates are going up, maybe you can buy some security for your operation by locking your interest rates in. So what's the fee to convert and payment of interest differential, if any? Another thing, depending on the risk of your loan, you might be taking a look at reporting requirements, and that comes off in the financing agreement. And that might be if you're risky and your repayment is tight, your lender may put on a capital purchase limitation, saying that you can purchase no more than $50,000 a year of capital purchase in your operation. Or they may say that your working capital ratio, you have to maintain it at a certain level, your current ratio. Or they may say that we want to see how well you're doing, and we want your financial statements within 90 days of year end. Now, there's different kinds of financial statements. You know, there's notice to reader, there's audited statements. Some of these don't cost much money, but some do. And what does that cost for you to provide the adequate reporting? Because if you have audited statements, that's quite expensive, depending on the risk. So some of those things will cost you because you might have to get another professional to help you to provide it. And that's another cost of doing business. Also, farming is a risky business, and we see that, like I said, a good guy can't pay when he wants, good guy pays when he promises. But sometimes there's payments that are late for unforeseen circumstances. We live in a winter country, and a couple of years ago we saw the avalanches on the CPR mainline, and it was 6 weeks that no grain left. January, February left the Calgary, that area of the province. So people had contracts and they had payments, but they weren't able to move any grain. If you go talk to your lender, more often than not, if you have the inventory, you'll get the time. But if you don't know, will they carry you through those periods if there's a problem? And what's the consequence of a late payment? It might be that you're charged a monthly accounting fee or management fee. And that could be $300 to $5,000, depending on the size of your loan and depending on the risk. Do you want to incur that extra cost? So that's, again, knowing what those costs are, and knowing what constitutes late payments or default. We also know that some of the lenders have flexible programs. We know that they'll go interest only if there's a disaster or something beyond your ability or your control happens, and they might just say, "Well, forego principal payments for this year, and just take interest only for you to catch up and strengthen your working capital." And some of those are built into the terms and conditions, and that you can negotiate. Sometimes if you can negotiate a better interest rate, because it's all on risk, if you have some things to risk mitigate and ensure that your payments are secure. That could be forward contracting, production insurance, enterprise diversification. So got to remember that the financial institutions will risk rate your operation, and depending on a number of factors, sometimes up to 16, that will dictate what type of margin they charge you on the interest rate. And it's good for you to be aware of that. It might be the enterprise you're in. It might be the amount of equity you have. It might be your repayment history. And your repayment history really drives how much interest margin you're going to pay for in the risk rating. So be aware of that. But lenders will respond with favorable financing terms if lower rates if you manage your credit well. Prepayment privileges. This is where often you'll see, well, you take a mortgage and you lock in the interest term and they say you can pay 15% of the original principal on maturity date. So say you borrow $200,000. On each maturity date you can pay $30,000. But that prepayment privilege may carry an extra few basis points in your interest rate because they're getting that money earlier and they have to replace it. So take a look. Can you really, yes, that's great that you can prepay, but really are you going to? Are you going to have the cash flow? Can you afford the working capital to take that $30,000 to put that into your prepayment? Or is it the interest cost that's more important to you? But also remember, on your income statement, it's not interest rate. Have you ever seen interest rate on your income and expense statement? It's the amount of interest you pay. So interest is the function of interest rate and the amount of principal outstanding. How do you rate your lenders? We've got a lot of lenders in the room today. They all sell the same commodity, money. They're all very competitive in the interest rates. They're all good people. But I know 10% of the people I know love me. There's about 10% hate my guts, and I'll never get them to the love me side. And there's 80% that are indifferent. So we know there are people that we can't work with or we don't see eye to eye. So you have to find that relationship with that lender or that producer that works for you. And is their institution in and out of agriculture? Are they in it for the long haul? Do they understand your business? Does your lender understand your business? That's a relationship that has to work because you're going to, as we go through our careers, like one of my friends said, he said, I'm 60 years old. I've been farming for 40 years. I've never owed so much money. I says, Rick, your farm hasn't changed in 10 years. He says, no, I bought a goddamn combine. With the exchange rate, it was $300,000 on a trade. He said, you think I have that money? It's all in the bin. It's all tough. I can't sell anything. So all of a sudden he had a $300,000 loan for a combine. Eats that $500,000 up pretty quick. So you have those relationships, nurture those relationships. If you haven't got confidence in that institution or they don't have confidence in you, try to find an institution and a lender that you can relate to and work with. Right now we see that lenders are analyzing creditworthiness on a combination of judgment and credit scoring models, and this looks at business performance and a lot of different variables. I know that right now on real estate loans, Farm Credit Canada can go up to $1 million on a scorecard. So they're taking a look at actuary, experience, a lot of factors, the risk in the business, and they're scoring it. And you should know what goes into that scorecard and manage it because that's going to give you access to credit and also affect your interest rate. And how much loan supervision. So another thing that is you should know when you're going in to see your banker and is your debt service capacity. And it's calculated accrued net farm income, and this is for sole proprietorship, plus depreciation expense, because that's a non-cash one on your income expense statement, plus interest costs, plus off-farm income, less family withdrawals, minus farm income tax paid. And why farm income tax paid? Because principal payments are made in after-tax profit. So if principal is paid in after-tax profit, you are going to pay farm income tax. So you should include that in that so that you don't short your working capital, so that you know and you can let your creditor know that you're able to make that principal payment. Profit's not a dirty word. often, as sole proprietors, we try to limit profit so we pay less tax. But if you don't make profit, how are you going to gain access to any capital or any loans? Because profit pays the principal. You also have to know your debt servicing requirements. And debt service is calculated by the interest expenses and long-term principal payments. So when you're adding an additional credit, take a look at how that's going to affect your principal payments. Then what the bank will take a look, take a look at the debt servicing capacity and debt servicing requirements. Is it positive? Can you make your payments? Before you even go to the bank and you're doing your financial plan, see if what you're planning to do actually meets its payments. Then what most financial institutions will look at is a debt servicing ratio. And that's calculated debt servicing capacity divided by debt servicing requirements. Industry benchmarks, if that ratio is 1.5, is low risk. That means for every dollar of debt service requirements, you have $1.5 of repayment capacity. If you're at that 1.1 to 1.5, that's medium risk. And if you're less 1.1, that means the likelihood of you making your payments, you haven't got any ability to handle anything in the market that goes up and down. Say crop prices go up, down 10%. That really affects your revenue and you're high risk because you won't be able to make your payments. So a checklist of agriculture credit, it's in this document. Understand your obligations, responsibility before signing all documents associated with the transactions. Know your role and responsibilities. Know the cost of fees due to loan origination, and if there's any annual fees, these go on top of your interest. You might get the best possible interest rate, but if you're paying annually a large fee, it might work that the other institution or another loan product might be more beneficial to you because it's cheaper. Review what constitutes loan default and what can accelerate the bank's demand for payment. Everybody's happy when the marriage occurs, when you sign the loan contract, so you get the money. But it's always what happens when the honeymoon's over. Understand what happens when the honeymoon's over. If you have a tough year and you can't make those payments. My recommendation is have a close relationship with your lender and get in to see them so there's no surprises. You'll see that they'll work with you with good communication. Determine the type of loan payment. What will the loan be paid fully at maturity? When we take an interest term, if you've been in default and you haven't followed your loan covenants, a lending agency does not have to renew your loan. They can demand the whole loan full due and payable. So you have to maintain that relationship and honor your responsibilities, because you could be coming 3 years in and the bank say, you know, your loan's renewing, it's $300,000. We want it all. We're not renewing it. That's a real big blow to your working capital. Obtain an estimate of your repayment schedule and your ability to meet the loan payments as you go forward. Do a projection over a couple of years. See what your requirements are, what your financial plan is. Is the interest rate fixed or adjustable? Does the loan carry variable or adjusted rate? What about the prime? If you're at a variable rate, is it prime plus 1, prime plus a half? What's prime going to do? We've seen prime been low, but right now, what is it, 3.15% or something like that? Is it going to move up? Bank of Canada said no. What do you see in the next couple of years? Is long-term rates good? And you have to understand that variable rates are off a different market, long-term rates are off a bond market. It's two different prices where the banks will purchase their money and then sell it back to you. Ask about prepayment penalties. Is it higher of 3 months interest or interest differential? What about prepayment privilege? Can you make a prepayment? Say if grandma gives you $15,000 or $30,000 you want to put against the loan. Or take me to Hawaii. Ask about recording requirements. What's required? what loan conversion options is a loan's term closed or open. Understand the consequences of late payment. And can you work with your lender? Is your lender understand your business, and does he want to work with he or she want to work with you? So a good tool that I found on ATB's website, you go to ATB Agricultural Banking Financial Calculators, you can take two loans and put them side by side and see what the costs are, what the amortization, how that affects you. And you can also print an amortization schedule. It's free. You can pull it up. You can see, even within the own financial institution, whether you should take fixed or closed or take a longer amortization, and then take those payments and fit them into your financial plan, and your working capital, and your cash flow plan. It's a good program. Other institutions also have loan payment calculators, but I found this one was really good because you could take two loans and put them side by side, or two different loan products. Also on this Farmer's Guide to Agricultural Credit, we also have a little checklist that you can go through and write those things that are important to you and compare loan products side by side. So with that, references that you can go find on the Farm Manager site: a Farmer's Guide to Agricultural Credit, a Guide to Agricultural Security Agreements in Alberta, the Personal Property Act, what it means to you, and working with your lenders, keeping in the loop. If we had tons of money, life would be easy, but most of us don't. And how do we lever our equity with debt so that we get the best return on our equity? And how do we manage it? And that's through a good financial plan and understanding the agricultural credit in this province, because there is some different rules. So with that, any questions? Great. Thank you for listening.